We got some breaking news from the Federal Reserve, and Jerome Powell and the Federal Reserve just cut interest rates by another 25 basis points today, and they're planning on turning on the money printer on December 12th. The rate cut itself is not exactly shocking news, and we all saw this coming from a mile away, but what actually matters is what was buried in the summary of economic projections and what Powell said during today's press conference. And New York Fed also released a statement that the Fed is going to purchase $40 billion a month in Treasury bills. And I pay attention to this as a FIRE investor because how I allocate my stock portfolio may change with more possible interest rate cuts in 2026. So here's the FOMC statement issued by the Federal Reserve today. I'm not going to read the whole thing, but the people who voted against the rate cut today was Stephen Moran, who preferred to lower the target range for the federal funds rate by 0.5 percentage point at this meeting, and Gooseby and Jeffrey Schmidt, who prefer no changes to the target range for the federal funds rate at this meeting. But what's more interesting is the statement that was released by the New York Fed, and if you scroll down to the middle of it, the desk plans to release the first schedule on December 11, 2025 with a total amount of RMPs of approximately $40 billion in Treasury bills. Purchases will start on December 12th, 2025. So initially, we all thought that the money printer was going to be turned on in February, maybe March of next year, but now they're starting to turn that on now. So let's talk about the elephant in the room. We had the longest government shutdown in history. The unemployment numbers won't drop until December 16th, and inflation data comes out on the 18th due to the shutdown, and they're all delayed. Now, think about that for a second. The Fed is supposed to be data dependent, and that's what they keep telling us. They make decisions based on the numbers, but here they are, making a major policy decision without having the latest employment and inflation figures in front of them. And we kind of see where we're going with the ADP private payroll data, but we're missing some critical details. And keep in mind that the Fed does not cut interest rates because everything is going great. They cut rates when they are trying to stimulate the economy, when they're worried about growth slowing down, or when they think employment might be softening. When Jerome Powell was asked if a rate hike is a base case in 2026, here's what he said.
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3 is not a big data set, but you are right about those 3 cut times in the 90s.
Now, let's get into the summary of economic projections, or SCP, that comes out every quarter. And according to the latest data, or what the Fed thinks what will happen in 2026, they think that the GDP will increase from 1.8% to 2.3%. And that is a huge change. And they think that the economic outlook is looking better than it did 3 months ago. And the unemployment rate is still at 4.4% from the previous projection. And if you look at here for the PC inflation, they think that the inflation will come down from 2.6 to 2.4% that was originally projected. And the core PCE at 2.5%. And now this one right here at 3.4%, they think that they're going to cut rates just one time. But I don't think that's going to be the case. I think they're going to cut rates multiple times throughout the year. Now, they're being very conservative with this because right now, as they said, it's very data dependent. So right now, they're just going to say we're going to cut rates in 2026 just one time. And that's what it says, right? One time. But this is potentially going to change. It could go down to 3.1, 2.5%, and all it's kind of depend on what it says in the next SCP, which will come out in March. I think we're going to get a better reading on how many rate cuts they're looking to do throughout 2026. And right now, in January, and I'm going to get into that later on, but the prediction or the probability of the Federal Reserve cutting interest rates down to 3.25 to 3.5% is at 25% right now. It's probably less than that when I pull that screen up, but that's where it is. But I doubt that it's just going to be one rate cut in 2026. Now, let's move on to the FOMC dots, or what we call the dot plot. And I'm telling you, this thing looks like a kindergarten project. And if you have never seen this before, it's pretty simple. Each little dot here on that chart represents where one of the Fed members thinks the federal funds rate should be at the end of the year. And it's an anonymous poll, a secret ballot, if you will. So we do not know who is who. And we don't know if that dot showing a super aggressive cut belongs to a dove, or if the high dot belongs to the biggest hawk on the committee. And according to today's SCP, the dot plots show over half of the members are below 3.5%, and the other half are above 3.5 to 4%, just keeping the interest rates where they are going towards the end of 2026. So that's where people think they should be. But this is all going to change throughout the year. So don't just take this PDF and say, all right, this is going to be it. And things are always going to change depending on how the labor data is going to show and how the interest rates or how the inflation is going to show throughout the year. And just last week, we got the private sector report, and it was a real head scratcher that probably pushed the Fed to move today. And they reported a monthly decline of 32,000 US private sector jobs in November. And keep in mind, that is just in November. Economists were expecting a gain of about 40,000 private payrolls. So this number of 32,000 job losses came in way below those forecasts. And this means the private sector, the real engine of job growth, just stalled out. The ADP National Employment Report, which is a highly detailed independent measure based on the payroll data of over 26 million private sector employees, confirmed this significant contraction. And the chief economist at ADP, Dr. Nella Richardson, pointed the finger at cautious consumers and an uncertain macroeconomic environment, noting that the slowdown was broad-based, but it was really led by a big pullback among small businesses. So let's look at where the damage was done in November. Goods producing industry shed 19,000 jobs. That includes manufacturing, which lost 18,000 jobs, and construction, which was down 9,000 jobs. And the service providing sector also struggled, losing 13,000 jobs in a month. The biggest hit, professional business services, kind of like my business right now, lost a painful 26,000 jobs, and information lost 20,000 jobs. And it was not all bad news though. Education and health services were a bright spot, if you will, gaining 33,000 jobs, and leisure and hospitality added 13,000 jobs. But when you look at the total picture, the private sector is clearly hitting the brakes. And it's not just jobs. Pay growth is slowing down too. Year over year pay for job stayers rose by 4.4%, but that's down from the 4.5% growth that we saw in October. For these job changers, the folks who can usually command a big raise, pay was up 6.3%, but that's a slowdown from the 6.7% growth they had the month before. When the private sector is losing jobs and the pace of pay raises is slowing down, that's a clear signal to the Fed that their prior rate hikes are working maybe a little too well. And that's why they're turning on the money printer to ease the economy so that they can ease the labor unemployment and just basically having more cash into the system, right? And this ADP data was a huge piece of the puzzle that gave the Federal Reserve the confidence to pull the trigger on the rate cut today, and despite the missing government data, and also turning on the money printer. When Jerome Powell was asked about the upcoming labor and inflation data during the press conference, here's what he said.
You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here? And have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
And here's what investors are betting on the Federal Reserve doing in January and March of 2026. Personally, I wouldn't pay too much attention to the March one, but for January 28th FOMC meeting, investors are betting that the 22% chance of the Federal Reserve cutting interest rates by 25 basis points, and that would bring the federal funds rate down to 3.25 to 3.5%. And if I take a look at March, which if I can scroll up here just a little bit here, now they're looking at a 41.7% chance that they're going to cut rates for the March FOMC meeting. And we're also going to get the summary of economic projections in March for that meeting as well. And there's a 7.8% chance that they're going to cut to 3 to 3.25% Fed funds rate. I mean, this is kind of too far out. What I would look at is probably January 28th, but all that data that's coming out next week, CPI, and as well as the unemployment data, those are the things that you want to look at and see what the Federal Reserve might do. Is it going to be more weaknesses, or are there going to be some recoveries in the coming months? We'll see, right? Because we're going to get 2 more CPI data, so we're going to get 2 more unemployment data. If they continue to show weaknesses in the unemployment data, then I wouldn't be surprised if they cut rates in January. I wouldn't be surprised if they cut more rates in March, and then the one after that in April, June, July, and maybe September. Maybe they'll cut rates every single time. And Jerome Powell, his last FOMC meeting, I believe is going to be June 17th. I'm going to have to fact check that, but someone else is going to take his place. We're probably going to find out who that replacement is going to be in the coming months anyway from the Trump administration. So I will stay tuned and find that out. So looking at the data we've gone over so far, it's clear that the job market is showing signs of slowing down. Now, I'm not here to freak you out, but I do want to be straight with you. And I think the job market may keep getting weaker as we move into 2026. And personally, I can see the Fed cutting rates more often as they respond to what's happening out there. The SEP showed 1 rate cut, but I don't believe that's going to be the case in 2026. Jerome Powell is also on his way out, and whoever President Trump appoints is most likely going to make a case of cutting more interest rates throughout the year. And here's something important to keep in mind. The summary of economic projections comes out every 3 months. So the next one is coming out in March 2026. We'll have a much clearer picture then, and with several more months of data to look at. And let me just be honest with you about this. And if the unemployment rate somehow hits 5%, don't be surprised if the Fed gets aggressive with the rate cuts and fires up the money printer even faster. And the Fed is already printing $40 billion per month starting Friday. On a personal note, with all this uncertainty, I want to be clear that I'm going to keep investing no matter what the Federal Reserve does. My long-term plan is still solid, although I may shift some things around to account for the ups and downs. And if you want to get into the details of how I am personally setting up my FIRE portfolio for this transition, you can always join my private community at firesitcher.com/community. And this has been another piece of a video, and I hope you got a lot out of it.